big story, and I've been talking about it a lot for actually a couple of months now, even longer than that, is inflation. I can't get away from it. Every week I'm trying to start the show off with a different topic, and inflation is the one that just keeps coming up. And if you're less than 40 years old, you've never seen inflation like this in the United States. And again, despite all the warnings, and we've been talking about it on this program for years, politicians in Washington just keep borrowing and they keep spending trillions upon trillions of dollars that we don't have. And the Federal Reserve keeps printing money and pumping it into the system, buying all our bonds, funding our deficits. And now the chickens have come home to roost. And, we knew this was going to be the ending here. I mean, you don't have to go far back in history to know that you can't just keep creating money without having inflation. And so now we have this big mess on our hands. And if anybody believes that this is going to be fixed easily by the Fed, they're delusional. It's not going to happen. So you better get used to this. And you better figure out a way to navigate it. And the one thing about economics is that most Americans pay very little attention to it until it affects them personally. Now it's affecting all of us personally. As we go to the grocery store, as we fill up our car, I drive the Parkway every day to work. Coming into the show today, I saw $3.70 for regular on the Parkway. I filled up yesterday. I get plus in my car. It's $4.12 a gallon. So we feel it now. All of us are feeling it. Whether we heat our homes, whether we're looking to buy a car, we're buying groceries, we're building a house. We'll talk about lumber in a second. I mean, everything is going up. Part of it is the supply chain as a result of the COVID madness. But what we have now is a perfect storm. We have money creation. We have all this trillions of dollars floating around out there. We have the stimulus from the COVID that we're writing checks to people, $300 a month for child credit. This money comes from somewhere and it's being created. And now the Federal Reserve is between a rock and a hard place and have to decide what to do. And I hate to be the one making that decision because whatever decision they make is wrong. There's no right decision here. And we'll talk about that in a second. So this past week, the producer price index was announced. It was hotter than expected, as all the inflation numbers are. And the year-over-year increase in producer prices is 9.7%. It was up 1% in 1 month alone. 1 month, January, producer prices up 1%. Now, again, it's worse than that. It always is. Anytime you hear government numbers double them, it's probably much worse than they say it is. Whether it's the unemployment, whether it's inflation, whether it's a GDP, these numbers are always fudged. So this is a record number, 9.7%. What are producer prices? Producer prices are the basic building blocks and resources that go into producing final products. Last week it was announced that, the week before last it was announced that the CPI, the Consumer Price Index, was up 7.5% year over year. If calculated the way it was calculated in 1980, the last time we had inflation, you could double it. So you're talking 15% inflation. With zero interest rates, still. But this is a brand new record, 9.7%. And why do we look at it? I look at producer prices very, very more importantly than consumer prices because producer prices show you what's in the pipeline, what's coming. You can't have lower consumer inflation if producer prices continue to rise. Whether it's energy, whether it's raw materials, whatever it is. Because ultimately, those products will have to be inflated at the consumer level. Otherwise, companies go bankrupt or lose tons of money. Let's look at some numbers out there. We know shipping is a big problem. Truck trailer prices in January were 29.6% higher than they were in January of 2021. And that's important. This all goes into shipping costs. In January alone, truck trailers were up 3.1%. They were up 3.8% in December. So when you see year-over-year increases in prices, 30% in this case, I mean, this is highly unusual in an economy that you really have very gradual inflation usually. How about this? Used car prices rose by an unbelievable 40.5% year over year. The best investment you could have made was buying your friend's used car. When have you ever heard that? When have you ever heard that buying a used car will go up in value? This is the Alice in Wonderland world that we're living in right now. I mean, used cars go down. They don't go up 40.5% in 1 year. That's because you can't get new cars for the most part, because new cars, they can't produce them because they can't get the computer chips. Every car is a big computer. It used to be when I was growing up that you'd be able to work on your own car. You tune up your own car, change the spark plugs, change the oil, and something went wrong, you'd be able to fix the carburetor. Well, not me, because I wouldn't know the first thing about that stuff, but you would be able to do it. Now you can't even touch the car because it's all computerized. You'll nullify the warranty. You got to bring it to the dealer, right? So without getting computer chips, we have a lot of idle manufacturers of cars. So you can't get new cars. So people who need cars are in the used car market, and they have bid up the cost of cars. And last year when I got a new car for my wife, I usually buy used cars a couple of years old, and the dealer told me, Lou, why would you buy a used car when you can get a new car cheaper? That's how crazy and insane things are. New cars, if they were available, if you could find them, and it took me a month and a half to wait to get it, were cheaper than the used car with 25,000 miles on it. When have you ever seen that? Never. And that's because the sticker price was determined the previous September. It doesn't go up over the course of the year, but used car prices went up, and we're exceeding the new cars. It's crazy. And my own car, which is 3 years old, I would love to sell it right now at a 40% increase over last year, but then I have to buy something. What am I going to buy? Energy prices, the biggest driver of inflation. Inflation will not start subsiding until oil prices start going down, or at least stabilizing. And we're flirting with $100 a barrel oil. I think that's easily going to be taken out. Some are even talking $200 a barrel oil. Well, $200 a barrel oil, you're looking at $8 gasoline. Boy, what would that do to the economy? But if you can believe it, the price of gasoline is up almost 41% since Joe Biden entered the White House and started destroying our oil industry. And energy is so important because energy goes into everything. It goes into shipping costs. Your goods are coming over from China. That tanker ship takes a lot of oil to power it, fuel, and it goes into the final prices. We have to heat our house. Someone said this week it costs an average of $1,000 more per family for energy per year, including gasoline, including electricity, including natural gas. I mean, that's a tremendous burden, especially on the middle class and the lower class, where 70% of Americans are paycheck to paycheck anyway, and have been for a number of years. The last thing a family needs is increased energy prices because you can't get away from it. What are you going to do? Not drive your car? Not go to work? Going to keep your house at 50 degrees? You can't avoid the use of energy. And energy flows through the pipeline to everything. Anything that's manufactured, it takes energy. Shipping, travel, everything is energy related. So keep an eye on the price of oil. It's so important. Oil had the first weekly loss of the year. It wasn't big. I think it's at $91, $92 a barrel. It was higher earlier in the week, and we'll see if it takes out 100 anytime soon. But we're looking at continuing rising energy prices. And it's every week I look at the price of gas, it's up 1, 2, 3 cents, and they just keep going up and up and up. And I know it's going to go up because I'm watching the price of energy. So you got to keep an eye on it. Price of lumber, we talked about it last year, it was surging last year. It was crazy to get lumber. Well, it's surging once again, and the National Association of Home Builders said the most recent surge has added $18,600 to the price of a newly built home. Just lumber. So we're seeing this every place in the economy. I certainly wouldn't want to be building a home in this environment right now. Not with the cost of lumber and everything else to build a house skyrocketing. So here we have the Federal Reserve, which has created this inflation through the printing of, well, I don't put the onus entirely on the Federal Reserve. I put it on Congress and politicians who keep borrowing money, who keep deficit spending, who did the stimulus packages. Well, where do you think that money came from? It was created out of thin air. And this is all part of the inflation that we're seeing. But the Federal Reserve has enabled the U.S. government to continue to borrow because the Federal Reserve has printed money every month to the tune of $120 billion. For a long time they've been doing it, and they've been buying our debt. And that's what's kept interest rates low. But now they are stopping the buying of the debt, as they say. They're stopping printing money, and now they may be doing the opposite. They're going to raise interest rates, and they're going to start selling the bonds they have on their balance sheet, which there's only one way that ends, and that's economic disaster. Rising interest rates, rising mortgage rates, falling real estate prices, increased deficit spending because the interest on the debt's going to go up. So the Federal Reserve meets in March. It's almost guaranteed that they're going to raise interest rates. Right now, it looks like it's going to be 0.5%. You know, big deal. We're going to go from 0% to 0.5%. That's not going to quell inflation. To quell inflation, they probably have to raise interest rates over 10%. Not 0.5%. And what's going to happen ultimately is the markets, and we're seeing it now, this year has been so entirely volatile. And a lot of it has to do with fear of the punch bowl being taken away from the markets in the form of low interest rates and virtually free money. And now it's going to cost money to get money. And we haven't seen rising interest rates for a very long time. Now, should we have a system where an unelected group of banking bureaucrats gets together every few weeks and determines what interest rates are going to be? That's a lot of power for unelected officials. In a free market system, interest rates would be set by the market. But we don't have free markets anymore. And we haven't for a long time. The Federal Reserve manipulates every market. They manipulate the bond market by printing money and buying bonds and keeping interest rates low. They manipulate the stock market, where magically the market's down big and always at 230, all of a sudden the market reverses and most of the losses disappear or even turn positive. How does that happen? Come on. There's something called the plunge protection team. That's what we call it in the industry. Officially, it's known as the Working Group on Financial Markets, which is made up of the banks, the Fed, and Wall Street, and the Treasury. Their job is to rescue markets. And this came about actually by Ronald Reagan. After the market crash in 1987, he formed this. And they're in the market all the time. There is no free markets. The markets are not allowed to go to where fair value is. Is fair value on the Dow Jones Industrial Average? Is fair value 34,000 or wherever it is right now? Of course not. Earnings don't justify it. But that's all manipulation by the bank. And again, they have so much power. And so what is the Federal Reserve going to do? Well, they're going to find more ways to mess things up. That's pretty much a given. Because whatever choice they have is the wrong one. What do I mean by that? Well, if they want to fight inflation, well, then they have to destroy the economy and destroy the financial markets in the form of a major crash like we haven't seen in a long, long time. I'm not talking about a short-term crash that we rebound a year later and everything's fine like we've had the last couple of crashes. No, it's not going to be that way. Because the only way they can do that is to reverse and bring interest rates to zero again, which they may very well do. If they do nothing and keep interest rates artificially low, well, we have rampant inflation and we'll have to deal with that. And that's the thing, politically. I mean, the Fed's not supposed to be political. It's not supposed to yield to pressure from the White House or the current administration. But the Fed always does. It historically has been very political. But whatever they do is negative for the current administration. If they raise interest rates and put us into a recession or worse and markets crash, well, that's not very good for the party in power. Especially so close to a midterm election. And if they don't do that and inflation runs rampant, that's not good for the administration either. And as a student of economic history, I'm fascinated by this. I am so excited to watch how this plays out. Not that it's going to play out well. It's going to play out horribly. We're on the road to financial ruin. And unfortunately, the people who are trying to fix the problem created it in the first place. Now, some are saying, well, one of the analysts from Citigroup came out and said that the Fed has to crash the markets. That's the only way they'll quell inflation. That's not going to happen because the Federal Reserve is not in the business of crashing markets. They're in the business of rescuing markets. Why is that? Because the rich people, the bankers, and all of that, they're the ones who own stocks. And that's the whole thing about asset inflation like we've seen over the last 8 years or so, where we've seen the stock market go up. We've seen real estate prices go up. Well, who owns this stuff? Well, 90% of the stock market is owned by the top 10% of Americans. Who owns all the real estate? Oh, wealthy people. I mean, we own our house, big deal. What good is our house going up in value if we can't sell it because we have to buy another one? We got to live somewhere. That doesn't affect, because your house goes from $300,000 to $400,000. That doesn't affect your financial situation one bit. It affects your net worth, but it doesn't make your life any easier unless you sell the house and cash out and pay off the mortgage and you have money in your hands. But now where are you going to live? In a box? So the Fed currently finds itself in a lose-lose situation where both choices are equally devastating to the country. Spark a recession or depression and crash the market, or let inflation run, or most likely both. And that's the thing. The Fed's going to make a mistake. The Fed's going to raise interest rates just enough to cause a market meltdown, to cause a bust in the real estate, to cause a recession/depression, while at the same time not raising it enough to really have any effect on inflation. So the question is, should they do anything? Should the Federal Reserve just keep interest rates at zero and say to heck with it? And my guess is this. My guess is the Federal Reserve is going to start raising interest rates. They're going to talk a good game. And as soon as the economy and the market start plunging, they're going to reverse themselves. And at that point, we're going to be right back to where we started, except with a lot of pain in markets to get there. So it'll be very interesting to watch. You have supposedly unemployment at 4%, which is almost full employment. You had GDP in the fourth quarter grow at 6.9%, if you want to believe the government. So here you have what's really, according to government numbers, a rapidly growing economy. You have low unemployment. You have high inflation. And you have zero interest rates. I mean, this is these are lunatics who are running the asylum at this point. Very, very interesting. And what the Fed can do, they can't battle inflation by just raising interest rates. They have to lower demand. Because there's so much money out there that's just chasing so few goods and services. That's what's bidding the prices up. They got to lower demand. And the only way you lower the demand is by making people feel poor. By having asset prices go down like stocks. If your portfolio goes down 30%, you're not likely to spend extra money to build a deck on the back of your house. You don't feel that wealth effect. You feel the negative wealth effect. Real estate prices going down. All these things take demand out of the system. And it won't take much in the way of interest rates to do that. We're seeing mortgage rates rise quite substantially in a relatively short amount of time. And that may give us that asset deflation, crash everything. That certainly would lower demand for things. Sure, crash all the markets, make everybody feel like they're losing tons of money. They're not going to be up for running out and spending money. There's something that's being resurrected, an economic number that we haven't heard about since Jimmy Carter, basically, and that's the misery index. What is the misery index, you ask? The misery index is a combination of inflation and unemployment. Two measures of economic pain. The index hit 11% in November and December and reached 11.5% last month, higher than any month in 2008 when the Great Recession began, and just behind its highest levels in late 2009 and early 2010 when unemployment was around 10%. The current misery index is the highest in a decade. So you're going to start hearing that now, the misery index. Like I said, I haven't heard it in 40 years. Americans are not feeling good about the economy. Only 23% say economic conditions in the country today are good or excellent. 37% say they're poor. Not that they're poor, but that economic conditions are poor. And a lot of that has to do with inflation. Another thing, new car prices are up. But what we're seeing, if you can find a new car, one recent new study found that 82% of new vehicle buyers actually paid above the sticker price during the month of January. That's unbelievable. We're living in an upside-down world. Nobody in the past ever paid sticker price unless you were a little old lady that didn't know any better and you walked into a dealer and they looked at you as, wow, we could get every dollar out of this person. Anytime I bought a car, I was there all day trying to negotiate every penny off the car. And quite successfully at times, to the point where you know you can get another dollar out of them. That's not happening now. There is no negotiations. The average price paid above sticker was $728 in January. Now, 2 years ago, if you were a good shopper of cars, you paid $2,648 below sticker price. That's over a $3,000 swing. Almost $3,500. In my entire lifetime, I've never seen anything like it. And again, I mentioned before earlier about the used cars, up 40%. That's nuts. Absolutely nuts. Gasoline in California hit a record this week, $4.72 a gallon. Regular. How long till $5 is the number there? Very bad economic conditions out there. So what are Americans doing? How are they making up for these higher prices? I mean, if most families are paycheck to paycheck and everything's going up in cost, well, either you're going to have to cut back, but you can only cut back so far. So how are they doing it? Well, they're doing it with credit cards now. Credit card balances hit $860 billion last quarter. up $52 billion in one quarter. That's the largest quarterly increase the Fed has seen in 22 years of collecting information on credit cards. The middle class is being systematically destroyed. I mean, it's happening right in front of our eyes. There was a day when the United States had the largest and the most prosperous middle class that the world has ever seen, and now it's disappearing. It's being absolutely eviscerated between the COVID situation, between rampant inflation. And, inflation is very bad politically. It causes uprisings. When you have trouble feeding your family, you're not a happy person, and you're not happy with your government, because the government's always going to get blamed, right? I was in the grocery store yesterday, and checking out, and the lady says, $154. And I said, only $154? That's cheap. Now, I was playing with her, of course. I was like, I can't believe the groceries are so inexpensive. And she goes, you know what? I'm just glad that the shelves are stocked. So in other words, I don't care if I have to pay more as long as I can get it. Because everybody's fearful of shortages. And rightfully so. And it's not just grocery stores and manufacturing plants that are feeling the shortages that are out there. The FDA released a number this week that more than 100 pharmaceuticals are in limited supply throughout the country, including antibiotics, diuretics, painkillers, heart medicine. There's 114 pharmaceuticals that are in low supply in January. Why? Because many of the ingredients for pharmaceuticals are sourced from China and India. Both countries have experienced prolonged COVID-related disruptions in their production. And as a result, the United States medical facilities and pharmacies are being impacted. Again, this is another problem we have. We outsourced everything. We don't make anything here in the United States. We depend on other countries. And then it's got to be shipped. And it's got to go through the ports. It's got to be offloaded. A trucker's got to take it somewhere. So this is rapidly becoming a big crisis. Imagine that. Your doctor gives you a prescription, and you go to the CVS, and they say, I'm sorry, we don't have it, and we don't know when we're going to get it. Unbelievable, the times that we're living in. It's like no other time in U.S. history. And unfortunately, I think it's just the beginning. And we're seeing the demographics in the country and the world. You have these extreme haves and you have extreme have-nots. And the middle class globally is being wiped out. And wealth is being redistributed to the upper people. Money always goes up. The truth is that the movement of cash always moves higher to the 1% and 2%ers who have gotten incredibly wealthy since COVID. Because they own stocks, they own real estate. And, they've been trying to sell us a story that we're moving towards socialism where everybody's taken care of. Well, it's a lie. All the wealth is being concentrated at the top. All right, let's take a break. 732-93, what's the number here, Jim? I can't even get it. 237. 732-237-9626. 732-237-9626 if you want to join us here on The Financial Physician. My name's Lou Scatigna. Dunk away.